Imagine opening your trading screen and seeing a US nuclear startup with zero revenue, no licensed reactor design, and no commercial deployment history, somehow valued at nearly $26 billion. Then imagine that in just a matter of weeks, without any catastrophic announcement, without any technology failure, without any criminal investigation, that same company loses roughly $12 billion of market value. And then, in the middle of this free fall, Wall Street launches a 2x inverse ETF designed specifically to short that one company, a leveraged product normally reserved for hyperliquid giants like Nvidia or Tesla, not for a pre-revenue nuclear engineering venture. This is not hyperbole. This is the unnerving and financially consequential mystery surrounding Oklo, founded in 2013 in Santa Clara, California. And to understand why Oklo's valuation exploded and collapsed to such extremes, why investors keep returning despite profound risks, and why the company occupies a unique place in America's technological and geopolitical landscape, we need to reconstruct with absolute clarity every anomaly that defines this story. At the heart of Oklo lies the Aurora powerhouse, a compact, fast-spectrum fission system that uses liquid metal cooling and recycled nuclear waste, basically high-assay, low-enriched uranium as its fuel. Under normal nuclear industry practice, reactors require periodic refueling using freshly enriched uranium, with each refueling cycle involving shutdowns, regulatory inspections, containment access, and carefully choreographed fuel handling operations. Oklo proposes a radically different pattern, a sealed reactor core designed to operate for roughly 10 years without refueling, manufactured in a factory, transported to a site, and integrated into a microgrid or a data center campus. In the US regulatory environment, such a design must pass through the Nuclear Regulatory Commission. Ordinarily, NRC licensing involves several years of iterative review, multiple rounds of safety analysis, detailed thermal hydraulic modeling, and extensive fuel qualification. This is why Oklo's January 2022 rejection of its initial combined license application was, in a strictly procedural sense, entirely normal. The NRC stated that Oklo lacked sufficient technical information. This is the common outcome for first-time applicants. What is not normal is what happened after. Instead of slowing, Oklo accelerated its momentum. Even before the rejection, the Department of Energy had granted Oklo a site use permit at the Idaho National Laboratory in 2019, a step that under conventional nuclear development trajectories usually follows years of validated data. After the NRC rejection, Oklo resubmitted a revised application in September 2022. But the real surge in market attention came not from regulatory progress, but from Oklo's extraordinary commercial announcement.